Hi everyone, and welcome to this CT video. My name is Sniper from Sniper Trading Mentorship. In the last video, we were talking about currency pairs, and I ended my speech with an additional video, which is going to be on leverage. So in this video, I'm going to talk you through the leverage. So I'm going to teach you everything you need to know about what leverage is, how to use it, and what to look for. So what leverage is? Leverage is actually a virtual loan given to you by the broker in order for you to have a bigger buying power in the market. So with leverage, you can control a larger position in the market than you will be able to with just your actual account, let's say $1,000 or $10,000. Then we will be talking about some of the dangers of using leverage as a beginner and why it's important to have a solid trading plan and risk management strategy in place when using leverage. So after that, we are going to be talking about how leverage works and how it can amplify both profits and losses. We'll also discuss buying power with 1 to 50 leverage, pip values with leverage, and the risk of margin call when using leverage. So what leverage is? So first of all, we are going to define the leverage. So leverage is essentially a virtual loan given to you by a broker in order for you to increase your buying power in the Forex market. So let's say, for example, you have $1,000 or $10,000 in your trading account and your broker offers a 1 to 50 leverage. So this means that you can control a position in the market worth up to $500,000. So $10,000, which is your actual account balance, times 50, which is the leverage. This is equivalent up to $500,000. So with leverage, you can control a much larger position than you would be able to with just your actual account balance. Now let's talk about the dangers of using high leverage as a beginner trader. So leverage can be a powerful tool for experienced traders, but it can also be very dangerous for those traders who are beginner and don't know how to use leverage effectively. So using too much leverage can lead to significant losses, and it's important to have a solid trading plan and risk management strategies when using high leverage. So let's say you have a $10,000 trading account and your broker offers a 1 to 100 leverage. So this means that you can control a position in the market worth up to $1 million. So $10,000, your initial account, times 100, which is the leverage in this case, it's equivalent up to $1 million in the market. However, if the trade goes against you, you could potentially lose much more money than your initial balance. A good example for this is, let's say you have $10,000 in your trading account and you decide to enter a trade without any leverage. So if the market drops by 2%, you will lose $200 from your account, which is 2% of your initial capital. Now imagine you having a buying power of $1 million with a 1 to 100 leverage. So if the market drops by 2%, you will lose a total of $20,000, which is 100 times more than the $200 loss you would have experienced without any leverage. So this means that your losses could actually exceed your initial capital. So in other words, while leverage can amplify your gains, it can also amplify your losses. So it's also really important to use leverage carefully and to have a solid risk management plan in place to protect your trading capital. So how does leverage work? As I have mentioned earlier, leverage allows you to control a much larger position in the market than your actual account in your broker. So this means that you both have potential profits and your potential losses are amplified when you use leverage. So let's say you have a $10,000 trading account and your broker offers a 1 to 50 leverage. Without leverage, you would only be able to control a position worth $10,000. However, with leverage, you can control a position worth up to $500,000. So if the trade goes in your favor, you could potentially make a much larger profit in your account based on the $500,000. But vice versa, if it goes the other way, you're pretty much going to lose a lot more money than without using leverage. Now let's talk about the buying power with the 1 to 50 leverage. Now that you understand what leverage is and how it works, let's take a closer look at the buying power. When you use leverage, you could increase your buying power significantly. Let's say if you have an account balance of $1,000 and you're using a 1 to 50 leverage, your buying power is going to be $50,000. This means that you can make trades that are worth up to $50,000 even though you only have $1,000 in your account. So this can be very appealing to traders because it allows them to potentially make larger profits with a smaller amount of capital. But however, it's important to remember that while using leverage, you can increase the potential profits, it also increases the potential losses. So if the market moves against you, you could end up losing more money than your initial investment. So let's take a look at an example of how buying power works with leverage. So let's say you want to buy 10,000 units of Euro USD currency pair at a price of 1.2000. Without leverage, you would need $12,000 in your account to make this trade. But with leverage, with a 1 to 50 leverage, you only need $240 in your account to make the same trade. So if the price of Euro USD goes up to 1.2100, you could potentially make a profit of $100 without using leverage. But with a 1 to 50 leverage, your profit would be $5,000 on the same trade if you were to use the same $12,000 capital but with the total buying power given by the 1 to 50 leverage. So now, let's talk about pip values with leverage. So another benefit of using leverage is that it can also allow you to increase your pip values. So a pip is the smallest unit of price movement in a currency pair. When you make a trade, your profit or loss is measured in pips. So let's say you are trading the Euro USD currency pair and the trade moves from 1.2000 to 1.2100. So that's a movement of 100 pips. So if you bought 10,000 units of Euro USD without leverage, your profit would be $100. Assuming a pip value of $1, but with 1 to 50 leverage, your profit would be $5,000, assuming a pip value of $50. So this is because of using leverage allows you to control more units of currency pairs, which actually increases the value of each pip. So however, it's important to remember that it can also increase the risks of losses. So let's talk about the risks of margin calls when using leverage. So a margin call occurs when your losses exceed the available margin in your account. So this means that you no longer have sufficient funds for the new positions and your open positions require more margin than your available equity can cover. The risk is particularly relevant when using leverage, as it allows you to open positions that exceed your actual capital due to the virtual loan given by the broker. So however, this also means that your actual market value of your position can be greater than your deposit, due to the leverage potentially increasing your buying power. For instance, if you have a $1,000 account without leverage, the maximum market value you could have in trades would be only $1,000, since you wouldn't have any increased buying power. In case of a margin call at a margin level of 50%, you will need to lose 50% of your account, which is a 5,000 pips loss assuming a pip value of 10 cents. However, with a 1 to 50 leverage, your risk of getting a margin call is higher. On your initial $1,000 account, the maximum buying power you could have is $50,000, which means you could only lose up to 100 pips before losing 50% of your initial account value, given a pip value of $5. Thus, the risk of getting a margin call is higher with leverage or higher leverage due to the increased pip value, giving you less room for losses. Therefore, it is essential to use a stop loss to avoid getting a margin call in case the price significantly moves against your position. Remember, using leverage comes with greater potential gains, but also greater losses. So that's all for today's discussion on leverage in Forex trading. We learned how it can increase both profits and losses, and the key factors to consider when using it. However, it's important to remember that leverage is a double-edged sword that requires the careful consideration of your investment goals, experience, and risk tolerance. To sum up, understanding leverage in Forex trading is crucial to making informed investment decisions. By keeping what we covered in mind, you will be better equipped to navigate the world of Forex trading with confidence. So thank you for staying on to the end of the video. I hope this has helped you to get a better understanding of what leverage is and how to use it, and also to be careful of using high leverage as a beginner trader. So if you don't want to miss out on Forex trading, be sure to follow me on Instagram. The link is going to be in the description below, and also follow me on YouTube so you will be updated about the new videos. So until then, be safe.